Okay, get this. What if I told you that you could make a 900% profit on a stock that only went up 28%? It sounds completely nuts, right? Almost like a magic trick. But it's a very real and very risky financial strategy. In this explainer, we're going to break down the incredible math behind options trading.
So this is the big question. How on earth can you turn 10 grand into 100 grand when the underlying stock only had a pretty decent but not world-changing 28% jump? It feels like the math just doesn't add up. Well, that's exactly what we're here to unpack.
The secret sauce here, the thing that makes it all possible, is a financial tool called options. Options are the key to unlocking these absolutely massive gains. But man, they operate on a razor's edge. You get it right, the reward is huge. But you get it wrong, and the fall is just as dramatic.
Yeah, let's be crystal clear about this from the start. This is a high-stakes game. It's a strategy with pretty much two outcomes. You either win big or you lose it all. There's very little in between.
To really understand how this works, we're going to follow an investor down two completely different paths. They start with the same amount of money. They have the same belief about a stock, but they choose two totally different ways to act on that belief. So, let's set the stage. Imagine you've got $10,000 ready to invest. You've done your homework and you are really bullish on Yelp, which is trading at 36 bucks a share. You're convinced it's going up. The only question is, what do you do with your money?
And this brings us to a fork in the road. Path A is the traditional route, right? You just buy the stock. Path B is the high-risk, high-reward shortcut, buying stock options. Same stock, same gut feeling, but as you're about to see, the outcomes are worlds apart.
All right, let's start with the fun part. Let's imagine our investor's prediction comes true. They bet the stock would go up, and it did. We're going to see what happens on both paths, starting with the simple stock purchase.
So if you take Path A, you take your 10 grand, and at $36 a share, you buy 277 shares of Yelp. Simple enough. You are now a part owner of the company. It's the classic approach.
And boom, your prediction was spot on. In just 1 month, the stock jumps $10 a share, all the way to 46 bucks. That's a solid 28% gain. Your hunch paid off big time. So what's your profit looking like?
Your profit is $2,770. Hey, that's a great return for 1 month's work, a nearly 28% gain. You'd take that any day of the week. But now let's see what happens if we take that same 10 grand and that same stock movement and go down Path B.
Okay, brace yourself because this is where everything changes. With Path B, instead of buying the stock, you buy what are called call options. Think of a call option as the right to buy a stock at a set price, here it's $38, within a set time, 1 month. And they're cheap. Each contract costs only 80 bucks, but it lets you control 100 shares. So your 10 grand buys you 125 of these contracts, giving you control over 12,500 shares of Yelp stock.
Now remember, nothing else has changed. The stock still makes that exact same $10 jump to $46. But this time, you don't own the stock. You own the options. So, what does your profit look like now?
$90,000. No, that is not a typo. Your initial $10,000 just turned in to $100,000. On the exact same 28% stock gain, the options path delivered a 900% profit. It is absolutely incredible. But this kind of rocket fuel can also blow up right on the launch pad.
Because we have to ask the question, what happens if you're wrong? We've just seen the mind-blowing upside, but now we have to look at the equally devastating downside. This is the other side of that high-stakes bet.
So, let's hit rewind. You made your bet, you bought your options. But what if the stock just fizzles out? What if it stays at $36, or maybe it only climbs to $37? What happens if it never crosses that $38 line before your 1-month deadline is up?
Well, here's the brutal reality. If you bought the stock and the price stays flat, you haven't lost a dime. You still own your 277 shares. But with the options, if that stock doesn't get above 38 bucks in time, they expire completely worthless. Your entire $10,000 investment, poof, it vanishes. A total loss. So, you're probably asking, how can these outcomes be so incredibly different? The answer comes down to one of the most powerful and dangerous concepts in all of finance: leverage.
I mean, this chart just says it all, doesn't it? The stock path has this nice, modest green bar for profit. But look at the options path. You've got this gigantic blue bar for the win, or a huge pink bar for a total loss. There is no middle ground. That's the deal you're making.
It all boils down to leverage. With options, your $10,000 wasn't just buying $10,000 of stuff. It was controlling 12,500 shares of stock, an asset worth around 450 grand. This leverage acts like a giant magnifying glass. When you're right, the gains are enormous, but when you're wrong, the loss is total.
And as if that wasn't enough, with options, you have another enemy fighting against you, the clock. You see, you can hold a stock forever, but options have an expiration date. This means you don't just have to be right about which way the stock goes, you have to be right about the timing too.
Yep, time is literally against you. Every single day that ticks by, if that stock isn't moving in your favor, your options are slowly bleeding value. That clock is always ticking, and it adds this immense pressure to the whole thing.
So, after seeing the wild highs and the crushing lows, what's the big takeaway here? It really all comes down to a fundamental choice you have to make about risk and reward.
You can think about it like this. Buying stock is like planting an oak tree. It's a patient, lower-risk game where time is on your side. Buying these kinds of options, that's like lighting a stick of dynamite. It's an explosive, high-stakes sprint where you are literally fighting the fuse. And that leaves us with the final question. And this one's really for you to think about. The potential for a 900% profit is, well, it's intoxicating. But the very real chance of a 100% loss is terrifying. So, knowing everything you know now, is that a gamble you'd be willing to take?